What is going on, everyone? Anthony Drew Gary here, host of the How To Show, where we talk about optimizing life, money, and happiness one how to at a time. I've been going back and forth for a little while now as to whether I should make this video because sometimes I don't feel like I'm qualified to do it, struggle with a little bit of imposter syndrome. But frankly, there's a discussion that probably needs to be happened about how to invest in the stock market. And I say that because I did a little bit of research, and in 2019, the suggestion was that only 53% of Americans were invested in the stock market. And so that means roughly half of all Americans are not invested in the stock market at all. And there are probably a number of different reasons for that, but if one of the reasons is because they don't know how, hopefully we can help with that. And so today I'm going to spend some time talking about how to invest in the stock market. I'm not going to talk about exactly what to buy. I'm just going to walk through the mechanics of basically how it works at a really high level, so that if this video can help you at least grasp the basics, I think that's really what we're going for here. And if it's of any correlation to what you might want to know in the future, it can be that good starting point to continue your education in the stock market. So really what I'm doing here is I feel like I'm addressing this video to me in the past. If I was in high school, I would have really loved to know some of this information. And so since that's not how it panned out, hopefully I can share this and somebody in the current situation can get some benefit from it. And so let's go ahead and talk about how to invest in the stock market. And we're going to switch over. I'm going to share my screen. We'll walk through things step by step. The first thing we're going to talk about is stocks. And a reminder here that I'm not recommending any specific stock or any specific instrument that we're going to talk about here today. I just want to do a breakdown of how this stuff works. And so stocks are going to be outlined in blue, and the colors will be important as we continue to build upon what we're talking about today. And as a general rule, a stock is basically a small sliver of ownership in a publicly traded company. And so you might hear from time to time somebody talking about Amazon stock, Google stock, maybe Apple stock, and their price that goes up and down. And basically this works in a supply and demand function. The more people buying, typically the price goes up. The more people selling, typically the price goes down. And so overall, there are opportunities to buy into the stock market by buying stocks. And I've listed a handful of companies. These are all big companies, but there are smaller independent companies that are publicly traded as well. There are thousands of them in the United States. And so this list could go on and on and on, but this is just a general idea of publicly traded companies. You might, if you've been reading the news lately, you might hear about GameStop, AMC, Tesla, NEO, all these different stocks that are trading that are popular. And so as a general rule, we just wanted to understand that buying stock in a company means you own a fraction of the company. And so in different companies, they're set up in different ways. You may have the right to do some voting in the board of directors sense, but basically you're owning the company with the hope that it goes up in value over time. And so your small stake of ownership in the company will go up over time as well. And so if we're going to talk about stocks, we should also talk about bonds for just a moment as well. Bonds are going to be outlined in orange. And so in a finance sense, a bond is basically an instrument of debt. And so if we think about bonds, there are really five main types. You've got treasury bonds, you have savings bonds, agency bonds, municipal bonds, and corporate bonds. And basically, if you think of things in the sense that stocks have volatility where they may go up in value, they may go down in value, and there's a bumpy ride along the way, bonds can be think about as more of a smooth ride. Basically, it's an instrument of debt with the expectation that a payment is going to be made to cover that debt over time, and there's a consistent return on the investment there, but it's typically relatively low as compared to the opportunity for stocks to go upward and downwards at bigger margins, bigger swings than bonds would. But want to talk about both of these in the sense that it's called the stock market, but within the stock market, there are opportunities to buy stocks. There are also opportunities to buy bonds. especially when you think about what we're going to talk about next, which is funds. And so funds are going to be outlined in green, and you may typically hear about funds in the sense of mutual funds, but I wanted to just call them funds here because as we show in the next slide, we have mutual funds, we have exchange traded funds, we have index funds. And so what we have here is if we start to use the color coordination, we have different funds that I've labeled. Again, I'm not recommending any of these, but basically, instead of buying individual stocks or individual bonds, you may find yourself in a situation where you're wondering, what stocks do I buy? What bonds do I buy? And if you are anything like me or anything like the roughly 80 to 90% of folks who lose money by buying and selling individual stocks, maybe you don't want to be in that game. You don't think you can be part of the 10% or the 20% who can pick individual stocks and make money doing that. Maybe you just want to buy a collection of stocks all at one time, and that's where funds really come in. And so you'll think about this in the sense of being able to take a whole bunch of different companies and put them in one basket and just buy shares of the basket. And so that's where we're getting our green outlines. Within the green outlines, you've got a whole bunch of different blue stocks. You've got maybe a couple of orange bonds. And that ratio of stocks to bonds is going to vary between different types of funds. And so it's important to do a little bit of homework on what is included in each fund because they're not all the same. There are thousands of funds. Some of them are managed by a company that picks the individual pieces of the fund, or some of them just straight up track an index. And what I mean by that is you may have heard of the S&P 500. These are the 500 largest companies in the United States. And you can typically buy a fund that tracks the S&P 500, which means that you buy a fund that has 500 companies inside of it, inside the bucket, and you can buy it all at one time rather than having to go individually click on them and buy them one by one by one by one by one. Just a layer of convenience to be able to diversify, to be able to buy multiple things at one time and just make it a little bit more convenient. And so that's what we've got when we're talking about the different types of funds that are in green. And so we'll keep going, and then we'll talk about accounts. And so each time you get a different color involved here, it's going to represent a layer of terminology. And I think it's important to be able to understand the different types of terminology because I think that the level of confusion is probably what holds people back from getting involved in buying into the stock market in general. And so to the extent that we can clear that up, we're going to keep doing it. So we'll keep going on. When you think about accounts, you have basically retirement accounts and non-retirement accounts. So you've got individual retirement arrangements, you've got 401ks, you've got 403bs, all of the different employer provided functions there. And then you've got brokerage accounts, which sometimes is called a taxable account. And what you have there is basically, this is taking money that you've already paid taxes on, you're sending it into the stock market, and it's not earmarked for retirement. You can buy and sell in this fund. And when you pull money out, you'll have to pay taxes on it. If you made money, you may be able to claim losses if you lost money. But basically, the two options on the top on the left here are retirement based. And then we've got the brokerage account, which is not retirement based. And then we've got health savings accounts, which has its own specific set of rules. I did a 2-part series on optimizing health savings accounts. If you want to check that out, click back to the channel, scroll back a couple of months, and you can find that. But to continue to look at this, so basically inside your account, so let's say this is a brokerage account. Inside that brokerage account, you can own the green funds, or you can own the blue stocks. You can own the orange bonds as well, I suppose. But basically inside the account level, you can still pick and choose different options in it. And so sometimes you may want to buy the fund, maybe you want to buy the stocks, but ultimately that is purchased inside an account. And so let's take that a step farther, and we will talk about custodians. And so custodians can be represented in purple, and those are basically the clearinghouses and the platforms that allow you to buy the stocks, the bonds, the funds. And so again, I don't recommend any one of these individually, but you have the companies at Fidelity, Schwab, Vanguard, Robinhood, M1 Finance, Webull, onward and onward and onward. There are a ton of different custodians. And so if you start to look at this, you've got a custodian, and inside that custodian's platform, you could have a 401k from your employer, you could have a taxable account, you could have a health savings account. For example, I know that Fidelity has all three options. In a past life, my 401k was through Fidelity. I know you can set up a health savings account that way, and you can set up a taxable account as well if you want to invest in stocks or individual segments there. And so again, inside your custodian, you have your accounts. Inside your accounts, you have funds. You can also have stocks. Inside your funds, you can have stocks or bonds. And ultimately, I just wanted to break down all of the different terms because it can get confusing. I am by no means an expert in this in my own right. I don't have a securities license or anything like that to be able to talk and give advice on this, but I just want to talk through the terms so that if you find yourself in a situation where you are interested in investing in the stock market, you can feel a little bit more confident about what you're doing because you've at least had some familiarity with the terms. That's going to bring this episode of the show to a close. Hopefully there was something useful in that video you can take away. If there was anything that was unclear, leave a comment down below. Let me know that. Ask your questions, and hopefully I can answer them or point you toward an expert who might be able to really continue that level of knowledge. And if you've got any ideas for future topics on the show, share those with me as well. If you haven't already subscribed to the channel, go ahead and do that. You'll be the first to know about new videos as they come. And if there's somebody in your life that you think could get some value out of this video, please share it with them because knowledge is power. And there's only one way to get those 47% of Americans who aren't invested in stocks, and that's by a combination of knowledge, know-how, and really just knowing that that's an option available to them. So until next time, this is Anthony Drew Gary, host of The How To Show, signing off.